The Independent Commission on Banking, chaired by Sir John Vickers, has just published its final report into the reform of banking in the UK. The report recommends that the bank's core operations, including consumer deposits and small business lending, must be ring-fenced from the rest of their businesses with a separate board of directors. Britain's banks face an annual bill of as much as £7 billion to comply with the reforms. Well, joining me now to talk about it is Patrick Jenkins, our banking editor. Patrick, crucially, there has been some flexibility there on the ring fencing. How relieved do you think will Britain's banks be?
I think it definitely is a relief. They'd been kind of gearing up and lobbying hard over recent months over this. They've been clear ever since April when the ICB's interim report was published that they were wanting to proceed with this idea of a ring fence. But by making it in certain degrees flexible, particularly on where corporate deposits should be placed, they can choose, basically, banks can choose to put them inside the ring fence or outside, and that means that those deposits can be recycled within the ring fence in terms of, into lending within the ring fence, or they can be recycled outside if they're kept outside. That is very important for HSBC as well as for Barclays, both of which have very different levels of deposits which need to be in different places. So I think it's evident in the share prices of the banks this morning that it is a relief. Interesting that they all opened down slightly this morning, but that really is the effect of the broader Eurozone worries, particularly over the French banks. Now they've moved back to largely flat. I think Barclays is still off as we speak slightly, but basically the movement is definitely upwards. And if you strip out the negative Eurozone impact, then, on a normal day, I think the banks would probably be 5% higher.
Business lobby groups, though, have warned that these reforms could still hit the wider economy in the UK. Is there a danger, do you think, that banks will actually struggle to lend to small businesses and that small businesses in the UK could face a competitive disadvantage to their overseas rivals?
Well, certainly, as you say, the impact, even that the ICB has assessed, is of up to £7 billion a year in terms of the funding costs for the banks. They argue that only a small portion of that will actually get passed on in terms of cost of lending to their customers. So John has estimated less than 0.1 percentage point on the cost of lending. So, for example, if you've got a business loan and you're paying 2.5% for it in terms of interest, you now have to pay maybe 2.6%, which doesn't sound like a great impact. Of course, the banks argue that that is by far underestimating the impact, and they point to the Ernst & Young Item Club assessment from last week, which estimated that the impact was going to be more like 1.5 percentage points. So in other words, a 2.5% interest rate on a loan going up to 4%, which is obviously a far bigger hit to any corporate client.
Now, if we just look, though, at what critics on the other side of the fence would be saying, do you think these reforms would have prevented failures that we have seen at Lehman Brothers, RBS, Northern Rock?
Well, there's a very interesting section in the ICB's report. It's 350 plus pages, but they basically make the case that, yes, these failures would have been prevented. It's less actually by the ring fence, which is the core ICB idea, than by the other measures that they're kind of building on, the international measures such as higher capital, higher so-called bail-in debt, the idea of a resolution regime that you could wind down failing banks. All of these ideas would have been crucial to preventing the crisis. So I suppose the big question that remains is, what is the purpose of the ICB's ideas that, in terms of distinguishing them from the thrust of already of global ideas that are already in place.
Okay, well, Patrick, we'll leave it for there now. Thank you very much indeed. Now you can get plenty more analysis, in-depth analysis of the Vickers report at ft.com/Vickers.